It's fair to say over the last 12 months we've observed a softening in what people are prepared to pay. So a softening in the valuations. Your 3 times plus are probably rare, where they were more the norm going back 12 or 18 months ago.
When people are out there saying, well, financial planning practices are worth 2 times, 3 times, 4 times, how can they possibly say that without understanding what the real value is?
Well, the business is worth what the buyer's willing to pay for it. We usually find that there's a valuation that's been struck before we're involved.
Well, at the risk of being a little bit controversial, many of the advisors out there perhaps look at their business and they sell themselves about the value of it and what that business can do. Whereas I'll be inclined to look at it on a realistic basis, as if we were going to buy it or we were going to sell it, and say, okay, what are the foundations of this business? What's been built at the bottom? What are its potential problems going forward? How much of that business would we lose if we bought it, or if we sold it, the purchaser, what would they suffer from? And the rule of thumb, of course, is 20%, and most people buying businesses don't want to accept that they're going to lose 20% of the business, yet historically the figures would show that they do.
After we start turning over a few rocks, we find things like disgruntled clients, employees who are leaving, or questionable past claims history. All of those things affect valuations per se. I think people get caught up in price and not so much on the actual value and the ability to transition the business cleanly.